Bitcoin did not start as a way to get rich. It did not begin as a speculative asset or a trending investment. Bitcoin was created as a direct response to a broken financial system, one that failed millions of people during the 2008 financial crisis in the United States and around the world. In 2008, major banks collapsed. Governments printed trillions of dollars to bail them out. Ordinary people lost homes, savings, and jobs, while the institutions responsible were rescued. Trust in banks and centralized financial authorities was severely damaged. It was in this exact moment that an unknown person or group using the name Satoshi Nakamoto released a white paper titled Bitcoin, a peer-to-peer electronic cash system. The idea was simple but revolutionary. Money without banks, without governments controlling supply, and without needing trust in any central authority. Instead of relying on people, Bitcoin relies on mathematics, cryptography, and decentralized consensus. At its core, Bitcoin is digital money. But unlike dollars, Bitcoin cannot be printed endlessly. There will only ever be 21 million Bitcoins. This fixed supply is one of Bitcoin's most powerful features. While the US dollar can be created in unlimited amounts, Bitcoin is scarce by design. Traditional money loses value over time because of inflation. When more money is printed, each existing dollar becomes worth less. This is not a theory. It is a measurable reality. Over the past decades, the purchasing power of the US dollar has consistently declined. Bitcoin was designed specifically to counter this problem. Bitcoin operates on a technology called blockchain. A blockchain is a public, decentralized ledger that records every transaction ever made. Instead of being stored on one server or controlled by one institution, the Bitcoin blockchain exists across thousands of computers worldwide. Anyone can verify transactions. No one can secretly change the rules. This decentralization is critical. In traditional finance, banks can freeze accounts, reverse transactions, or deny access. With Bitcoin, ownership is determined by private keys. If you control the keys, you control the money. No bank approval is required. Another core principle of Bitcoin is transparency. Every transaction is visible on the blockchain. This does not mean identities are public, but the system itself is fully auditable. This level of transparency does not exist in traditional banking systems. In the early years, Bitcoin was mostly used by technologists and libertarians. It had little value and was often dismissed as worthless. In fact, one of the most famous stories in Bitcoin history is when someone paid 10,000 Bitcoins for 2 pizzas. At the time, this seemed reasonable. Today, that amount would be worth hundreds of millions of dollars. As Bitcoin grew, so did skepticism. Critics called it a scam, a bubble, or a tool for criminals. Governments questioned its legality. Media coverage was largely negative. But Bitcoin continued to operate exactly as designed, block by block, year after year. What many people failed to understand was that Bitcoin is not a company. It has no CEO. It cannot go bankrupt. It does not depend on profit or management decisions. It is a protocol, like the Internet. And just like the Internet, once it reached a certain level of adoption, it became extremely difficult to stop. In the United States today, Bitcoin is no longer fringe technology. It is discussed by lawmakers, held by institutions, and integrated into financial products. Major companies hold Bitcoin on their balance sheets. Regulated Bitcoin ETFs exist. Banks offer crypto-related services. What was once considered impossible is now reality. But to truly understand Bitcoin's role in modern finance, we need to go deeper into how it actually works, how new Bitcoins are created, and why its structure makes it fundamentally different from any form of money that came before it. And that brings us to the engine that powers the entire Bitcoin network. To understand Bitcoin, you must understand how it operates without a central authority. The system works because of a combination of cryptography, incentives, and distributed computing. Every Bitcoin transaction is grouped into a block. These blocks are linked together in chronological order, forming the blockchain. Once a block is added to the chain, it becomes nearly impossible to change. This immutability is what makes Bitcoin secure. But who adds these blocks? This is where mining comes in. Bitcoin mining is the process by which transactions are verified and added to the blockchain. Miners are participants who use powerful computers to solve complex mathematical problems. When a miner successfully solves a problem, they earn the right to add the next block and are rewarded with newly created Bitcoins plus transaction fees. This process serves 2 purposes. First, it secures the network. Second, it controls the issuance of new bitcoins. Unlike central banks, which can create money instantly, Bitcoin releases new supply gradually and predictably, approximately every 4 years. Bitcoin undergoes an event called the halving. During a halving, the reward miners receive is cut in half. This reduces the rate at which new bitcoins enter circulation. Historically, halving events have played a major role in Bitcoin's price cycles. Security is another area where Bitcoin is often misunderstood. Many people believe digital assets are inherently insecure. In reality, the Bitcoin network has never been hacked at the protocol level. The blockchain itself has proven extraordinarily resilient. What people often confuse with Bitcoin being hacked are failures of exchanges, wallets, or users. When someone loses Bitcoin due to a scam or poor security practices, it is not a failure of Bitcoin. It is a failure of human behavior or centralized platforms. Bitcoin's security model is based on incentives. Miners are rewarded for honest behavior. Attempting to attack the network would be extremely costly and economically irrational. The larger the network grows, the more secure it becomes. Another key concept is decentralization. Bitcoin nodes, computers that run Bitcoin software independently, verify transactions, and enforce the rules of the network. No single entity can change the supply limit, reverse transactions, or shut the system down. This is why Bitcoin is often described as trustless, not because trust does not exist, but because trust is placed in code and mathematics rather than institutions and people. From a financial perspective, this changes everything. It introduces a form of money that operates independently of government policy, political decisions, and central bank interventions. For Americans, this is particularly important. The US dollar is the world's reserve currency, but it is also subject to monetary expansion, debt accumulation, and political pressures. Bitcoin offers an alternative, not necessarily a replacement, but a parallel system. As adoption grows, Bitcoin's infrastructure continues to improve. Wallets are easier to use. Custody solutions are more secure. Regulation is becoming clearer. Institutional-grade products now exist. Bitcoin is no longer just a technological experiment. It is a functioning financial network processing billions of dollars in value. But technology alone does not determine value. Perception, adoption, and economic incentives play a major role. To understand Bitcoin's place in the future, we must examine how it fits into investment strategies, market behavior, and long-term financial planning. That is where things become truly interesting. Bitcoin is often compared to traditional investments like stocks, bonds, and gold. But Bitcoin does not fit neatly into any existing category. It behaves differently, carries unique risks, and offers distinct advantages. One of the first things investors notice is volatility. Bitcoin's price can rise or fall dramatically in short periods. This volatility scares many people away, but it also creates opportunity. Historically, Bitcoin has experienced multiple cycles of rapid growth, followed by deep corrections. Understanding these cycles is crucial. Short-term speculation often leads to emotional decisions, buying at highs and selling at lows. Long-term investors, however, focus on fundamentals rather than price fluctuations. Many successful Bitcoin investors follow a strategy known as dollar-cost averaging. This involves investing a fixed amount at regular intervals regardless of price. Over time, this approach reduces the impact of volatility and removes emotional decision-making. Risk management is essential. Bitcoin should not represent 100% of a portfolio. Instead, it can serve as a diversification tool. Because Bitcoin does not move in perfect correlation with traditional assets, it can reduce overall portfolio risk when allocated appropriately. Institutional adoption has changed the investment landscape. Hedge funds, pension funds, and asset managers now view Bitcoin as a legitimate asset class. The introduction of Bitcoin ETFs in the United States has made access easier for mainstream investors. However, risks remain. Regulatory changes, technological developments, and market sentiment can all impact price. Bitcoin is still a relatively young asset, and uncertainty is part of its nature. Education is the most powerful risk mitigation tool. Investors who understand what they own are less likely to panic during downturns. They recognize volatility as a feature, not a flaw. Another important distinction is between trading and investing. Trading focuses on short-term price movements and requires skill, discipline, and risk tolerance. Investing focuses on long-term value and patience. Most people are better suited for the latter. Bitcoin rewards patience. Historically, those who held Bitcoin through multiple cycles were rewarded, while those who attempted to time the market often underperformed. But Bitcoin is not just about financial returns. It represents a philosophical shift, a move toward financial sovereignty. For individuals who value control over their assets, Bitcoin offers something no traditional investment can. As more Americans seek alternatives to debt-based systems and inflationary policies, Bitcoin's appeal grows. It is not a guaranteed path to wealth, but it is a powerful tool when used responsibly. To fully appreciate Bitcoin's potential, we must look ahead toward regulation, adoption, and the evolving role of digital assets in the global economy. The future of Bitcoin will not be defined by hype or fear. It will be shaped by adoption, regulation, and integration into existing financial systems. In the United States, regulation has moved from hostility to cautious acceptance. Lawmakers now recognize that banning Bitcoin is neither practical nor beneficial. Instead, the focus has shifted to consumer protection, taxation, and financial stability. Clear regulation is a positive development. It provides certainty for businesses and investors. It encourages innovation while reducing fraud. Bitcoin thrives in environments where rules are clear and fair. Institutional involvement will continue to grow. Banks, asset managers, and corporations are building infrastructure around Bitcoin. This does not mean Bitcoin becomes centralized. It means access becomes easier. Globally, Bitcoin serves different purposes. In developing countries, it provides access to financial services. In unstable economies, it acts as a store of value. In advanced economies like the USA, it functions as a hedge, an investment, and a technological innovation. The long-term success of Bitcoin does not require it to replace the dollar. Even a small allocation across global portfolios represents enormous demand. Critics will continue to exist. Skepticism is healthy. Bitcoin does not need universal approval to succeed. It needs continued usage, security, and relevance. Bitcoin has survived market crashes, regulatory threats, media criticism, and technological challenges. Each time, it emerged stronger and more resilient. For individuals, the most important question is not whether Bitcoin will succeed, but how it fits into their financial goals. Education, discipline, and long-term thinking are key. Bitcoin is not a shortcut. It is not guaranteed. It is not risk-free. But it is one of the most important financial innovations of our time. Those who take the time to understand it, rather than fear it or blindly follow hype, will be best positioned to benefit from whatever the future holds. And that future, whether we realize it or not, is already being built, one block at a time.